It is 2026. The noise is deafening. The markets have reset.
Imagine a scenario where an investor is starting from absolute zero. No safety net, no inheritance.
Just the knowledge accumulated over 3 decades of navigating the treacherous currents of Wall Street. The conventional wisdom, the advice echoed by every retail broker and automated robo-advisor, screams for diversification. They say to buy the haystack. They say to spread capital across 500, maybe 5,000 companies, praying that the winners offset the losers.
But here is the brutal truth that Wall Street rarely advertises.
Diversification is primarily a hedge against ignorance. It is a strategy for wealth preservation, not wealth generation.
If the objective is to build a fortress of capital from the ground up, the rules change entirely. One does not need a collection of mediocrity. One needs a concentrated strike force.
If the goal were to rebuild an empire today, the Capivestor strategy dictates ignoring 99% of the S&P 500.
It requires deploying capital into just 4 specific equities. 4 titans.
No bonds, no speculative crypto, no gold. Just 4 businesses that possess what is known as terminal durability. Why? Because statistically, most stocks are effectively debris. They are average businesses with eroding margins destined to underperform the index.
To compound capital at a rate that actually alters one's financial reality, the investor must find the anomalies.
However, before unveiling the first titan, understand this. This strategy requires a psychological fortitude that most investors lack. There is a specific trap in the third asset on this list that catches the vast majority of retail investors off guard, often causing
The first pillar of this reconstructed portfolio receives 30% of the total capital. It is not just a technology company. It is the modern equivalent of a global utility. This is Alphabet.
To view Alphabet merely as Google is a fundamental error. This is a toll road on the information superhighway.
With a global search market share hovering above 90%, it is effectively a monopoly in all but legal name.
Every time humanity has a question, Google extracts a micro-toll in the form of advertising revenue. It is, perhaps, the most elegant cash flow engine ever designed.
But the thesis for the next decade goes far beyond the search bar. The focus here is YouTube.
If one analyzes the viewing habits of the next generation, YouTube is not just a video site, it is the new
Then, there is the hidden giant, Google Cloud. We are in the early innings of a massive secular migration of enterprise data to the cloud. This division is growing at a blistering pace, poised to generate tens of billions in operating income. Critics will point to the AI threat. They fear that large language models will render search obsolete.
The sophisticated analyst views this differently.
Alphabet owns DeepMind. They invented the transformer architecture that makes generative AI possible.
They possess the world's most comprehensive proprietary data set.
In the war for artificial intelligence, Alphabet is not the victim. They are the best armed combatant on the field.
They possess the distribution, the data, and the capital to integrate AI, not be replaced by it.
Financially, the company creates a fortress.
We are talking about over $80 billion of free cash flow annually and a balance sheet holding over $100 billion in cash.
It is a financial bunker.
Yet, the market frequently misprices it, allowing the astute investor to buy $1 of earnings for less than the cost of the average S&P 500 company. However, while Alphabet dominates the digital air we breathe, The next selection dominates the financial ground we walk on. The second allocation, taking 25% of the portfolio, is Visa.
If one were to design the perfect business model in a laboratory, it would look like this.
Visa does not lend money. They do not take on credit risk. If a consumer defaults on their debt, the issuing bank suffers, not Visa.
Visa is simply the network. They sit in the middle of the global economy, taking a small cut, a royal.
The margins here are nothing short of staggering. Operating margins consistently hover around 65%.
Visa converts more than half of its revenue directly into free cash flow. This is the definition of a compounder.
The bear case for Visa has always been disruption. For a decade, headlines have claimed that cryptocurrency or decentralized
Crypto remains volatile and complex. The average consumer demands friction-free convenience. They want to tap a card and leave.
Until a competitor and replicate a network were capable of saying 60%.
Furthermore, consider the inflationary hedge. As prices rise, the transaction value rises, and Visa's fee.
But even the strongest digital moats have a weakness. They exist in the abstract. To build a true
For the third position, allocated at 20%, the strategy targets Costco Wholesale.
This choice often confuses the novice. Costco is a low-margin retailer. It is boring.
It is warehouses and pallets. But look closer. Costco is not a retailer. It is a membership club.
The genius of the model lies in the membership fee. Costco sells goods at virtually zero profit, sometimes even at
Their real profit, the billions that hit the bottom line, comes almost entirely from the annual fees paid by 130 million members.
This creates a recurring revenue stream that is more akin to a software subscription than a grocery store. The renewal rate for these memberships consistently exceeds 90%. That is not customer satisfaction. That is religious devotion.
But Costco possesses a financial weapon that is invisible to the average shopper. It is called negative working capital.
Here is the magic. Costco sells the inventory to the customer before they even pay their suppliers. They collect cash today, but they do not pay the vendor for another 30 days. Do you see what happened?
They are effectively operating their multi-billion-dollar empire using other people's money, interest-free.
While other retailers drown in debt to fund inventory, Costco is sitting on a mountain of cash generated by this timing mismatch.
It isn't just a store, it is a bank disguised as a warehouse.
While Amazon dominates the digital realm, Costco has proven impervious to the e-commerce onslaught. Why?
Because the treasure hunt experience of a physical Costco run cannot be digitized. The value proposition is too strong.
In a recession, people flock to Costco to save money. In an economic boom, they flock there to spend their surplus.
It is an all-weather vehicle for capital compounding.
However, a portfolio of stocks and tech can still be vulnerable to systemic shocks in the public markets. To truly safeguard this wealth, exposure to real, hard assets is required, the backbone of civilization itself. This leads to the final pick, allocated at 25%, Brookfield Asset Management.
Brookfield is the invisible empire. They are one of the world's largest owners and operators of real assets. We are talking about hydroelectric dams, vast solar farms, thousands of miles of pipelines, data centers, and prime real estate. Unlike a typical stock that fluctuates on sentiment, Brookfield owns the infrastructure that society relies upon to function.
Their advantage lies in their complexity and their timeline. They raise massive funds from institutional giants to a dollar. This allows Brookfield to be a contrarian. When the market is crashing and liquidity dries up, Brookfield has the cash and the patience.
They are targeting 15% annual growth in distributable earnings, a number they have hit with remarkable consistency.
By owning Brookfield, one is not just buying a stock, one with perhaps the most sophisticated
This provides access to private equity and infrastructure deals that are typically reserved for the ultra-wealthy. So, the architecture of the 2026 portfolio is set. 30% Alphabet, the digital utility. 25% Visa, the financial toll road. 20% Costco, the consumer fortress. 25% Brookfield, the real asset empire. 4 positions. That is it. Now, why resist the urge to add a 5th or a 10th? Because in the game of capital accumulation, history's greatest investors, from Warren Buffett to Charlie Munger, built their fortunes by betting heavily on their highest conviction ideas. If historical trends hold, and remember, markets offer no guarantees, only probabilities, the risk does not lie in the number of stocks owned. The risk lies in the quality of the businesses held. The probability of all 4 of these dominant titans failing simultaneously is statistically negligible. But here is the final, most difficult component of this strategy. It is not the buying, it is the waiting.
The strategy requires the investor to execute the trade and then do nothing. One must possess the discipline.
One must let the mathematics of compounding do the heavy lifting.
This is how empires are built, not through frenetic trading, but through the patient ownership of exceptional businesses.
If you are ready to stop gambling and start engineering a financial future, looking deeper into the mechanics of wealth, I am Capivestor. Master the capital, become the investor, claim the victory. I will see you in the next one.